Hello, I'm Craig Stone, Co-Portfolio Manager of the Kayne Anderson Rennick Small Mid-Cap Portfolio. Today, I would like to briefly review the KARS Mid-Core Portfolio for 2022 and highlight the outlook for small mid-cap stocks and discuss what we believe are the benefits of investing in quality, which is the cornerstone of our philosophy. Despite the relative outperformance of the KARS Small Mid-Cap Core Portfolio in the fourth quarter of 2022, we could not overcome the underperformance experienced during the first quarter of 2022, which resulted in an underwhelming absolute and relative performance for the full year. So what happened in the first quarter of 2022 that so dramatically impacted performance for the rest of the year? It was a combination of already accelerating inflation trends supercharged by the Russian invasion of Ukraine that led to a spike in commodity prices. Our lack of direct energy exposure in our portfolio and the stickiness of the higher commodity prices put us at a distinct disadvantage for the year. As the year progressed in 2022, the market continued to favor more commodity-oriented businesses, many of which are found in the energy sector. Given our focus on high-quality businesses with low capital intensity, our portfolio is underweight energy given that these type of companies typically have high capital intensity and are highly commoditized. Energy was the only sector that had a positive return in the Russell 2500 index in 2022 and by a wide margin. While the overall Russell 2500 index ended 2022 with a negative return of minus 18.36%, the energy sector within the Russell 2500 index had a positive return of over 50%. Our largest attractor from the portfolio were consumer discretionary and technology names, which are long-term holdings and outperformed in the years 2020 and 2021. While the market sold off aggressively in 2022, after careful review of all of our holdings, we decided to continue to hold despite the sell-off, believing that the situation for these companies are more cyclical in nature rather than challenges to the structural advantages that these companies have relative to their industries or potential competitors. We are encouraged by the fact that these have been strong performers at the start of 2023, and we maintain high conviction in these companies. Looking forward, we believe that after a period of underperformance, the valuation of smaller market cap companies are looking more attractive relative to the larger market cap companies. In the following charts, you can see the past 20 years of the Russell 2500 index relative to the larger market cap Russell 1000 index as measured by price of sales near the 20 years lows last seen during the global financial crisis in 2008 and 2009, price of cash flow also near 20-year lows. And finally, trailing price to earnings. Once again, we have to go back to the global financial crisis to find comparable opportunity. We also believe the unprecedented monetary and fiscal stimulus that has been put into the system since the global financial crisis has disproportionately benefited large cap US stocks. The top-heavy S&P 500 companies like that of Meta, Apple, Microsoft, Amazon, and Alphabet are having significant fundamental growth issues, which has not been the case since 2008. Partly evident by the recent slew of headcount reduction announcements by some of the largest S&P 500 companies. In turn, we believe this trend may reverse, and we can see multi-years of outperformance by smaller market cap companies, which can continue to grow in a lackluster economic environment. Lastly, I want to emphasize the importance of quality, particularly in a continuing inflationary and higher interest rate environment. The Federal Reserve's hawkish monetary policy, combined with improving supply chain issues, appear to be working in reducing the core inflation rate. Inflation concerns, however, have been replaced by impending recession fears in the market. The stock market seems to be already pricing in a moderate recession for 2023. It is unlikely that the Fed will reduce the Fed rate near term in fear of reinflation after working so hard to quell inflation. Thus, it is possible that we see a medium-term scenario where interest rates stay consistent at current levels. After all, we're still well below the long-term interest rates seen over the past 50 years, as evident by the chart. And as inflation rate normalizes along with the interest rate going forward, we believe it is prudent that we continue to focus on companies with good balance sheets. In the following chart of high-yield spreads, one can see it is currently only near long-term averages. And one can also see that historically, this high-yield spread tends to spike during recessionary times, as seen over the last 2 recessions. And if we are indeed headed for another recession, then the typical spike in the spread rates will be much more harmful for highly leveraged balance sheets, a trait that is typical of low-quality businesses. In our experience, the high-quality businesses with strong balance sheets tend to benefit on a relative basis during higher spread environments. From our perspective, slower growth, higher interest rates, looming recession fears should all support high-quality investments with advantaged business models that can deliver more meaningful revenue growth, solid returns, and with better balance sheets to protect against the potential of a more severe recession or other unknown economic events. As always, we thank you for your continued confidence, and we appreciate your interest in our small mid-cap portfolio. Please feel free to reach out to your CARB representative with any questions or for any additional insights into our investment strategy.